Greetings to all, and thank you for returning to Everything Tesla Stock. We're talking to Kevin Paffrath, a popular YouTube influencer and Tesla stock analyst who runs the Meet Kevin channel today. Kevin has been outlining how the present state of the economy affects Tesla and its stock price in his most recent videos. He has also offered his opinion on what investors might anticipate in terms of Tesla's future and current stock prices. You should keep watching this video if you're interested in knowing more about Tesla's future. Meet Kevin predicts that Tesla will likely have its hardest quarter in the second quarter before trying to recover. As a result, it appears that Tesla's stock price will not decline much more and will instead soon begin a robust comeback. This will remain the case unless the president of China decides to shut down the nation entirely once more. In that scenario, Tesla would be impacted because one of its primary factories is located in Shanghai. We predict that Tesla's stock price won't drop below $600 per share because Meet Kevin thinks the company's value won't decline much more. Meet Kevin further asserts that the profits per share, EPS, for the second quarter are anticipated to be lower than those for the first. You shouldn't be deterred by the statistical prediction either, as there are more factors to take into account when projecting Tesla's future. Regulation in the autopilot business, for instance, is growing, which is actually a good thing because Tesla is a leader in this area and may be able to influence how these regulations are developed. Get together furthermore, according to Kevin, the price of Tesla's stock will not only stop falling, but even try to rise with a genuine price explosion. This alone is one of the primary causes of Tesla's 3-for-1 stock split, which we discussed in our earlier video. Research from Bank of America indicates that corporations that divide their stocks frequently beat the market. This is explained by the fact that more investors purchase stock in a company when they believe the stock is selling at a discount. The price will progressively increase as more and more investors race to purchase the company's stock. Meet Kevin looks into the history of the corporation in an attempt to forecast potential future movements in the price of Tesla stock. Tesla's deliveries are a primary estimation. Meet Kevin highlights that Tesla's actual deliveries for the prior quarter, which totaled 254,700, fell short of the estimated range of 255,000 to 268,000. Meet Kevin brings up an intriguing statistic on S/X deliveries, stating that they exceeded 16,162, signifying a roughly 10% rise in S and X car manufacturing in comparison to the preceding quarter. Even though COVID laws forced the closure of the Shanghai factory, Tesla just disclosed financial records indicating that the business manufactured more cars in July than ever before. This indicates that Tesla is probably headed for a quick recovery in its stock price. Meet Kevin claims that if Tesla continues at this rate, it may be aiming to create roughly 1.8 million cars a year, compared to the 1.4 million predicted by the market. It's a great indication that Tesla will shortly recover. According to Meet Kevin's projection, Tesla is expected to make 1.4 million cars in 2022, growing at a rate of 50% to 60%. By 2023, Tesla is expected to generate 2.2 million cars, followed by 3.9 million in 2024 and 5.8 million cars in 2025. Demand is also crucial, and it appears that there is a sufficient market for Tesla cars. Yes, consumers are purchasing electric cars from other manufacturers at the moment, but it's possible that this is due to their inability to wait for Tesla. More people would purchase Teslas if the company produced enough cars to meet demand for electric vehicles without making customers wait months to obtain their automobiles. Given that many of the people who are currently purchasing alternative electric vehicles are also potential Tesla customers, Tesla has a large amount of untapped production growth. This is fantastic news for Tesla since it indicates that the automaker may continue to expand at a very high pace of roughly 50% to 60%. The revenue per car is currently at $52,000, but it may go up in the future. We must maintain it at $52,000, since doing so will increase our revenue to almost $300 billion USD by 2025. With other revenue streams and the assumption that Tesla would deliver the anticipated 5.8 million vehicles total revenue in 2025 could reach over $355 billion. Remember that one of Tesla's more distinctive advantages is that there is no additional dealer layer. As dealers typically keep around 10% of the automobile sale price in their own pockets to maintain the dealership, this is actually quite advantageous to margins. This is known as dealer markup. Instead of losing the 10% to the dealer, Tesla kept the 10% to itself and eschewed the whole dealership scam. Many investors ignore this and fail to consider the positive news that this information brings to the company's margins. Tesla's price-to-earnings ratio is at 66. Although it's not a horrible statistic, given the state of the economy, COVID, geopolitical tensions, and other factors, it may be depressed. This suggests that in the upcoming years, Tesla's price-to-earnings ratio may increase. Let's not get ahead of ourselves, though. In just 4 years, Tesla's stock price should be close to $2,200 USD a share if the company can sustain its price-to-earnings ratio of 66 and get closer to 20.5. This amounts to a 33.57% yearly rate of return. Based on Meet Kevin's predictions, it appears that Tesla is an excellent company to invest in. Over time, its stock price is expected to rise dramatically, providing investors with a nice return. Please remember that this is a longer-term investment that we are discussing. Due to the current market volatility, short-term investments may not yield a return because it is very difficult to forecast what will happen in the near future. Meet Kevin also takes into account the fact that Tesla has laid off 10% of its workforce in his film. The recent layoffs at Tesla have surprised some investors, but as Meet Kevin points out, the majority of the people fired off were workers. This just demonstrates that Tesla is a sophisticated AI company and does not require human capital to accomplish some of the basic activities. It does not imply that the company expects to produce less or anything of the sort. It is true that there were other employees who left the company, though. However, this is encouraging since it indicates that Tesla is aware of the state of the economy and the potential for a recession. The company is making cost reductions and preparations for hard times. Meet Kevin says that given the current situation, this is typical and that investors shouldn't be unduly alarmed by these layoffs. Tesla will be able to boost profits during the crisis by eliminating some overhead, which is precisely what investors want to see if some employees are let go. In his Tesla videos, Meet Kevin mentions the impending earnings recession, which makes this particularly beneficial. When a business experiences consecutive quarters of negative revenue, it is referred to as an earnings recession. Some large corporations are already experiencing this. Nike, for instance, has frequently reported negative revenue of roughly 5%. Reducing costs by making layoffs can help prevent this scenario and maintain the company's growth, as Tesla has demonstrated. As a result, as Meet Kevin reveals in his videos, a lot of actions that initially appear to be negative indicators for the business actually serve as deliberate measures taken by the organization to guard against difficult and unpredictable times. The company's healthy cash flow is another indication that Tesla is performing admirably. As Meet Kevin points out, money is entering Tesla every day rather than leaving. It's remarkable for a startup, particularly in the auto sector where a large number of U.S. automakers have declared bankruptcy. It appears that Tesla will be able to escape this fate. But if Tesla's cash flow is negatively impacted for whatever reason, many investors may become hesitant to make investments, which might have a negative impact on the company's stock price. However, Meet Kevin's analysis indicates that Tesla's cash flow is expected to be positive for the time being. In summary, Meet Kevin's video indicates that Tesla's price per share won't drop much more, and we think it won't drop below $600. There are numerous indications that Tesla will recover and that its share price will rise sharply over time. In just 4 years, Meet Kevin estimates that the price of a share of Tesla should reach approximately $2,200 USD. Please share your thoughts with us regarding Tesla's future, though. Post your forecasts and predictions in the comments section below. I appreciate you seeing. In addition to liking and commenting on this video, please watch the rest of our videos and, most importantly, subscribe to the channel. Select one of these two videos to watch on your screen while you're still here.